everybody, welcome back to my Daily Dose with Tim. Today is season 2, episode 19. Oh my goodness. Okay, we're almost 4 weeks into season 2 already. And I think the first couple of weeks we had a slower start, and all of a sudden week 3 and this week I've been getting so many different messages and so many different questions from you guys, and that's awesome. And I just want to let you know to keep those coming, because I keep saying that whilst a lot of times, you guys are not watching this live, however, I know you're actually coming back to review these things, and questions do come up. And sometimes even when I watch back, I know there are points that I really want to make, or some of the things that I want to really explain more thoroughly, and I didn't really get to, because I'm always a little bit aware of how much time has gone by every time I do a video as well. And I really am doing everything that I can to really squeeze these videos in at about 15 to 20 minutes per episode, just so that it's bite-sized chunks that makes it very easy for everybody to absorb and digest the content. And now today I'm actually going to kind of take it back to some of the basic stuff very quickly, because thanks to one of your questions, and you were reminding me that, hey, you know what, maybe I actually need to explain the inverse relationship that cash flow and ROI tend to have. And this is something that I've mentioned quite a few times in passing. And for some of you guys, if you've been doing this, you probably understand what I'm saying. However, for some of you guys, if you're actually just starting out, I am sorry, I forgot to really touch on this, and today this is what we're going to do. And to just make things a bit smoother, okay, I've already pre-written out some of the criteria, and I'm hoping that you can see this, just because every time we do deal analysis or we utilize numbers to demonstrate concepts and principles, there tends to be a lot of things on it. Okay, so some of you guys are asking, when you guys go through the training with Trust Your Talent, is it going to be the case? Yes and no, because those of you who have actually worked with me, you understand I really emphasize on the thought process, number one. To me, that's the most important thing. If you're very clear in the way you want to analyze your deals and structure your deals, you should be able to do it with pen and paper if you're clear about the process and your objective that you're looking to hit. However, the other side of all of this is I keep saying I am actually not a techie person. I really am not. And so what that also really means is that I've had so many different experiences ever since my university days, where I could be writing a paper, it could be my blood, sweat, and tears literally for 2 weeks, and all of a sudden there's something wrong with the computer or with my disk. Back then, I think we have floppy disks. If you're old enough to know what that is, yay. And I've just had way too many experiences where technology does not cooperate with me. And these days, especially when we rely a lot on Wi-Fi, on connections, and it just fails you, it's not the greatest feeling. So my whole point really is, yes, on the one hand, you will be given spreadsheets so that it makes the process a lot smoother and a lot easier. However, on the other hand, I still want to make sure that every person is able to actually formulate a complete thought process on deal analysis and deal structuring, okay? So coming back to this today, cash flow versus return on investment. And again, if we're going to use income properties or the concept of income properties to demonstrate this idea, then I want you to remember that, yes, we say return on investment, and that's become more of a universal term. And you guys know I also did an episode back in season 1 basically discussing the main differences between return on investment versus cash on cash, okay? So even though I'm saying return on investment, just remember in this particular case, it will be your cash on cash return until you have a clear entry and a clear exit of the deal that you are looking to calculate your overall return on investment on that particular deal. Now, today, the example here is, let's say we have a purchase price of $500,000, and I'm going to say this is a property located right here in the province that I live in, which is Alberta, Canada. Once again, for some of you Canadians, you know exactly where I am. For some of you guys who are watching internationally, maybe Google Map it. I'm in Alberta, Canada, and for us, what that really means is when we're actually buying a property, there is not a tax called land transfer tax. For my friends over there in the UK, that's the stamp duty that we're referring to, okay? And in most provinces in Canada, there is land transfer tax. And Alberta and Saskatchewan, as of today, are still the only two provinces that do not have that tax implemented. And so what that really means is when it comes to the cost of acquisition, it's actually slightly lower than the other provinces, okay? So I'm gonna give you some of the parameters as well. On the performance side, fair market rent, I'm gonna say 2,200. I mean, this can really depend on the area, the condition, and the size of the property. I'm just gonna say 2,200 just for argument's sake and just for demonstration, okay? So please don't take it as any sort of indication in terms of that's the kind of rent that you would get for a single family home, detached, 3-bedroom, 2-bath, fenced in with garage space as standard, okay? And then taxes and insurance, I'm just guesstimating at 500 so that it makes it a lot easier for us to do the math in a little bit. And that being said, though, I basically split this up into 20% down payment. Again, if you are buying a property as an income property, meaning you're not living in there, it's not your principal residence, in this country, you need a minimum of 20% down payment or deposit. In a lot of cases, simply because of the fact that we do teach you how to protect your assets and create tax shelters, what that really means is that most of the times we will encourage and even insist that you purchase your income properties using corporations. So what that really ends up meaning a lot of the times is that lenders actually want you to have a little bit more skin in the game, meaning instead of 20% down, they want to see you put down 25%. Okay, so that's why there is a bit of a split. So if you do the math right off the bat, 20% down, you're looking at $100,000 in cash that you have to come up with. And then 25% is $125,000. And usually in a normal purchase scenario, we also have other expenses that are considered as part of the acquisition expense. Now, notice we're not doing flips, we're not doing value add at the moment. Okay, so I'm just gonna give you very straight up. This is your fair market value. We don't have to burr anything. We don't have to do a renovation. The appraisal expense would be $500 upfront, give and take, and then inspection is $500 as well, and legal expenses because we have to pay a licensed lawyer to close the deal, to do the conveyancing process for us, and their favorite words, billable hours, right? And other than billable hours on the legal fees, don't forget that you always need to budget in disbursements, okay? So if you're getting quotes from lawyers, just make sure that whenever they give you an amount, clarify whether or not disbursements have already been estimated into the quote that they're providing you with. So let's take a look here. And for a lot of you guys, you can actually just leverage a simple amortization calculator. Or for us Canadians, remember, we use the Canadian Mortgage app, okay? That's the one that I'm going to be using here with everybody. And so what we're doing here now is let's calculate the full acquisition cost, okay? So right here we have $100,000 from down payment, and then we have all these expenses. So what that means is our cost of acquisition, depends on how you want to call it. I'm just going to call it cost of acquisition here, is all these things added together. So you have a total of $103,000 right here. And so on the other side, if we're doing 25% down, then we have a total cost of acquisition on this side of $128,000, okay? And so what we're going to do now is we're going to go into our mortgage calculator and going into the purchase calculator side of things. Home price, we're going to punch in $500,000. Okay, so here is one quick thing that I do want to touch on because it's something that I also mentioned. For us Canadians, why do we have to use a special app for this? Because if you're our neighbors in the US or in any other countries for that matter, as far as I know right now, Your mortgage rates are calculated and compounded annually as advertised, whereas for us Canadian folks, we end up paying a little bit more than the rest of you guys. Why? Let's just say that the bank posted rate is 2%, 2% per year, okay, on a mortgage. What that really means is we actually compound that semi-annually. So what the bank does typically is they will take 2% divided by 2, semi-annually means twice a year, so divided by 2, so every 6 months it actually gets compounded by 1%. And so what that really truly means is that Canadians, we end up paying more in interest when we get a mortgage, okay? So that's really what the point that I want to make there. That's why we have a special app for it. So for those of you who are not in Canada, make sure that you use a regular mortgage calculator or an amortization calculator that's available to you. And so coming back here now, 500,000, we're gonna say down payment is 20%. We know that already, okay? So 20% is $100,000. Let's just verify that. And I'm just gonna pick an arbitrary rate of 3% right now on a 5-year fixed, okay? On a 5-year fixed. And so over 30 years, over 30 years. So I'm gonna write this down for you just so that we can all make sure we refer back to it and have the same numbers, okay? So 3% in 5-year fixed and over 30-year amortization. I'm writing a little smaller so I can make sure we fit everything on the same page so that the summary later looks okay to you, okay? And so what that really means is that now we have a PI of principal and interest, which is your mortgage payment, of 1682.41. Remember, I like to round it up a little bit, so let's just do 1683, okay? And so on the other side now, let's go back to the purchase calculator. Instead of 20% down, we're going to do 25% down, and everything else held constant. Okay, we now have a monthly payment of $1577.26, and so what that means now is, let's round it up a little bit once again, is $1578. So in both cases, I basically just rounded it up by a few cents, really. That's all there is to it, okay? Just so that it's an easy, clean number for us to work at. So let's figure out what the cash flow is on this side, okay? Cash flow, in this case now, let's take out our little calculator, is fair market rent. So let's just say that assuming the $2,200 is our actual rent that's being collected on a monthly basis. And in this case, once again, I've done a lot of disclaimers already in terms of some of the considerations that we're omitting at the moment, which is vacancy, repair, maintenance, and property management, especially if you're not self-managing, okay? So all we're doing is demonstrating the concept of the inverse relationship between cash flow and your return on investment. And so coming back here now, 2,200 minus our pity payment, so 1683, and then minus our $500. So guess what? Whopping $17 a month in our cash flow in this case. And on the other side, we have 2,200 minus 1578, and then minus 500. So now we have 122 per month. So on paper, right off the bat, if I were to give you or present you with an opportunity that's going to give you a monthly income stream of $17 versus 122, which one do you think most people would want? Well, they would want 122, right? The more the better, because that is your profit. You want higher profit on a monthly basis because that signifies that your business is actually doing well. That means your property is performing better, so to speak. However, let's now take a look at our cash on cash return. So cash on cash return, the reason why I like doing return on investment sometimes is also the fact that it just makes it easy. Return on or return sitting on investment. Okay, so return right now is $17 per month times 12 months. Our initial investment, okay, we already said initial investment is basically our cost of acquisition is $103,000. So upfront, it seems like, well, you know what? If we only have to spend $103,000, it's better than having to come up with $128,000. However, now you can see the more we put down, the higher the cash flow. However, let's keep going with this first. So 17 times 12 divided by 103,000, and then 100%. Guess what? Horrible, 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 horrible. 0.2%. That sounds awfully a lot like putting your money in the savings account these days. Anyways, these numbers are not indicative. I'm just proving a point right now, okay? Most properties in this market actually performs a lot better than that. Now, on the other side, same math, okay? So we have 122 times 12, and then divided by 128,000. And then let's take a look. 122 times 12, and then divided by 128 times times 100. There we go. Okay. So again, 122 times 12. I press something. Divided by 128,000, and then times 100%. There we go. So 1.14. All right. So guess what's happening here? Do you see the irony? Okay. We have a return that's 122, so technically that's higher than that, right? And this is why there's a lot of scenarios that we can go into, because apples to apples, in this particular case now, the inverse relationship is actually not quite proven, simply because of the percentage that we have put down here, and also there are other considerations that we've actually put away. So remember, I named this the inverse relationship between cash flow and ROI. Why? Because technically speaking, okay, when you get more cash flow, that typically means that one of the factors in your expenses are actually going to be lower, giving you a little bit more. And the biggest driver is typically your down payment amount. Okay, so going back here now, in this case, we have 1.14% versus 0.2%. So we're actually happier in this particular case. Now, this is part one of the two parts that I'm going to be doing with you, because today I wanted to show you the 20 versus 25%. However, tomorrow we're going to look at what actually will drive it to be that inverse relationship that we're talking about. In this particular case though, just remember the example, and we're gonna tweak it a little bit, and then you will see how it flips super quickly, okay? Now, I'm gonna leave that as part one for today, and tomorrow we're gonna come back and keep exploring this, just so that you fully understand what we mean by that inverse relationship. Because in this particular case, that has not been proven yet. So stay tuned. Now, thank you once again for inspiring me, for touching on different topics with you as we go along season 2. There's a lot of things that I've still got planned for you. Remember, we got 12 weeks and we're only pretty much at the end of week 4 at the moment. And so tomorrow we're gonna come back and really wrap this up so that you guys can really fully understand. And the reason why I want to go through this with you is because a lot of the times when we're doing our DO analysis, what we're always doing is to look for ways to improve performance. And performance a lot of the times means improving cash flow and improving return. Okay, so if we're always usually dealing with the fact that they have an inverse relationship, then what do we actually focus on? So that is what we're going to be solving with tomorrow's episode. So thank you so much again for joining me today, and thank you for sharing the stuff that I've been making with people that you think can actually learn from and can benefit from. So I appreciate your support, and I look forward to seeing you back here tomorrow. So have a great evening, everybody. Live well.